Welcome to episode 1 of Graphite Hub's interview series, a series dedicated to all things graphite. In each quickfire session, we'll chat with key figures within the graphite industry, like today's guest, David Christensen, Managing Director of Renascor Resources. Today, we'll touch on how they're navigating the current market challenges and how they see the medium to long-term outlook for the graphite industry. So welcome, David.
Thanks, Harry. Great to be here.
Cool. Would you mind just providing a brief overview to investors on who Renascor Resources are?
Sure. Renascor Resources is an Adelaide-based minerals development company. We're now active in the critical mineral space after we've discovered what's grown into one of the world's largest graphite resources in our home state of South Australia. Our Sivia resource is currently the largest, second largest proven reserve of graphite in the world, the largest reserve outside of Africa. And our plan at Renascor is to produce not just a graphite concentrate, but to take advantage of our location in a safe, modern industrial jurisdiction and go one step further down the value chain and refine it into a purified spherical form. We think that'll open up greater margins, but maybe more importantly, it'll expose us directly to what we think is a high growth area in the graphite space, which is lithium-ion battery anode.
Okay, great, awesome. So not only are we seeing the wider market facing some current challenges at the present time, but also the graphite market specifically is kind of experiencing some short-term difficulties. How do you see the medium to long-term outlook?
Yeah, I think that's right. I think we've seen probably over the last 18 months or so the battery minerals sector, if you will, experienced downturn, and probably led most prominently with what we've seen in lithium prices coming off from big highs, but graphite, similar sort of situation where in graphite, sort of 18, 24 months ago, the Chinese were importing relatively low volumes on a net basis per month, and we saw prices that were 60-70% higher than they currently are. And then that stopped. And right now, we're seeing really the opposite, where the Chinese are no longer net importers. And instead, they seem to be subsidizing not just capital developments, but even potentially operations. And that's driven the graphite price down. And that's the world we're currently living in. But if we sort of fast forward, none of us think this is sustainable. And we don't think that because we're continuing to see increased EV usage and increased production of lithium-ion batteries, both in China and outside of China. And if we look at the graphite supply chain, you're going to need more graphite, whether it's a synthetic or in a natural form. And I think most forecasters are predicting increased levels of usage, but we live in the short term. So we think sort of that medium term starts to look very good, where we're likely to see better pricing. And our job here is to try to negotiate that the best we can by trying to work the best we can to take advantage of what we think those medium term prices are going to be, advance our projects to get into that space. And really that's what we're trying to do here, because we think that medium term really looks good for two reasons. The first is what's happening in China is we don't think sustainable. It's not sustainable because even the Chinese companies aren't making money. I think they recently reported that the anode companies, only one anode company is making a positive profit. But we're not seeing this only in anode. We're seeing it in cathode. We're seeing it all across the graphite supply chain, whether it's natural graphite providers or spherical providers or natural or synthetic anode, and even the material that goes into synthetic, whether it's pet coke or graphitization. And if we sort of move back to let's say the market equilibrium we saw just 18 months ago, then the world looks quite different, and lots of graphite projects become profitable. The other thing we're likely to see, we think, is something to be done on the public policy front, where the increased dependence on China is really putting in question the entire ability of the EV sector to survive outside of China. And probably the group who's leading this, obviously, is the United States, with whether it's the Inflation Reduction Act or the implementation of tariffs. We've seen some measured responses that are starting to have some degree of impact. But that's the sort of wild card that could give rise to a very quick and a very rapid change in the market. And this is why the two factors, what's happening in China, I don't think really anyone believes it's sustainable. But then moreover, the West is going to have to develop new supply chains. So companies like us have to deal with the volatility and try to advance our projects the best we can to take advantage of what we think that medium term is what we're dealing with, obviously the volatility in the short term.
Great. And so further to that, how is Renascor navigating these short-term challenges?
Yeah, so I guess, probably in a couple of ways. One thing is we have a relatively healthy cash balance, and that has to do with the timing of our capital raises. And so I think we had just about 110 million at the end of the last quarter. So it puts us in a good position to not have to put down tools in the mining space. We're used to dealing with booms and busts. I think in lithium, we've seen, two or three of these things just in the last 5 to 6 years. We're seeing a bit of it in graphite now, obviously. What we want to do is we want to sell into that future market. We think the medium-term prices are going to revert to what we saw a couple of years ago, if not go much higher, if we're even half right on some of our forecasts are. So what that means for us specifically is, in particular, the upstream. We want to get the upstream ready to be in production as soon as possible. And really what we're trying to do is move that forward so we can reduce the risk and reduce the cost. So specifically, what does that mean? We've commenced an early contractor involvement to do feed level engineering on the mineral processing plant. That'll give rise to an EPC contract. And then that de-risks it, and hopefully it allows us to find optimizations within the project itself. We've moved forward with some of the longer term capital items. We purchased the land. We've worked with SA Power to get our grid connection going, and some of those longer lead time items we're working on. And then at the same time, we're trying to unlock what is really probably the better value proposition, which is moving into the downstream sector. We recently got a co-funded grant from the Australian government to do a pilot plant, and that'll be a process which will hopefully be able to unlock not just that value from the upstream, but downstream. And if we sort of fast forward in what we're doing, where we're looking at sort of a year and a half once we get to FID to get into the commissioning. So we really are working into that medium-term market. And the challenge for us right now is to ensure that we can get into that as quickly as possible. And if we're successful at this, then we can benefit from what we think is probably going to be the inevitable changes in price. So for us, it's really all hands on deck trying to de-risk and make that upstream project as valuable as it can and get ready to put that into production as quickly as possible so we can benefit what we think is going to be the inevitable push in price.
Yeah. Well, thanks, David, for sharing your insights on the graphite market. We appreciate your time and we look forward to having you again here in the future.
Great. Thanks very much,
Cool.
Harry.
Well, thanks all for tuning into this episode of Graphite Hub's interview series. We'll see you next time.